Hi everybody, my name is Jason Heath. Welcome to the Objective Financial Hour. We've got with us today Promod Sharma, who is a marketing actuary for Taxevity. Met Promod recently, and I would have to say he's very different as it relates to the insurance industry. He offers very different services than many people in the insurance industry. He's very well versed and has worn a number of different hats. Wanted to introduce Promod and welcome to the show. I guess first off, Promod, I wanted to ask you a little bit about your background. You've sort of come from one part of the insurance industry and ended up on a completely different side. Can you tell us a little bit about your past?
Oh, absolutely. And I actually have a few slides that I can show that will maybe make that more interesting than me just telling you.
Sure.
So my career has had three different phases. In the beginning, I was an apprentice, so I was working at an insurance company and I was learning how to become an actuary. Mm-hmm. And then after that, I was at another insurance company, and there I was making products, so designing them. So I saw how things worked from inside the industry. And then I spent about 5 years helping advisors sell, and there I saw a whole different side of the industry. And I realized that I was on the wrong side. Rather than helping the industry, I thought that I would be better helping the public if I were on their side and helping them buy, rather than helping the insurance industry sell.
So you started off, in effect, although not directly, selling insurance, and then became more an advocate for buyers of insurance, is what I gather. I guess maybe just to go back to the start now, an actuary, I've not come across a lot of actuaries, and there could be a lot of our viewers out there as well that aren't really sure what an actuary does. An actuary crunches numbers.
Well, there are different kinds of actuaries. An actuary is trained to do two things. One is measure risk, and the other is manage risk. Mm-hmm. So we're dealing with contingencies, so things that are not easily predictable for a person but can be predicted in aggregate. So looking at exciting things like the chances of people dying or getting a disease, etc.
So typically an actuary would be somebody that was working on the inside of an insurance company, helping an insurance company figure out how to price risk, how to price insurance, how to do things like that, as opposed to somebody on the other side working for consumers?
That's right, because actuaries are not inexpensive, and multi-billion-dollar companies have money to pay them. It's tougher for the public to have those kinds of resources or needs.
Okay, fair enough. So when you were working in the insurance industry on the inside, are there certain themes that you found that led you and caused you to go a different direction?
Well, when I got into the insurance world, I decided when I was in university, I was young and naive, and I wanted to make the world better. And I thought that insurance was a way to achieve goals like that. And when I got involved in the industry, I saw that it was a business like any other. And there's nothing wrong with business, but I saw that there were a lot of resources on the side of the industry and the advisors, but I didn't see a lot of people helping the public in making decisions, because insurance is quite complicated, and I just didn't find the public had good advice. And what I started doing there is blogging. That was about 2007.
Okay.
And so I've got a screenshot that just shows some of the blogs I've written. It's over 500 now. What happened is people started coming to me for advice because they found me online.
And people being consumers as opposed to insiders in the industry, presumably?
That's right. Originally I started blogging to show advisors how, through generosity, they could help the public and presumably get more clients. But I didn't find a lot of other advisors who started to blog, but the public was coming to me because they probably didn't know where else to go.
So it was rather unintentional that you ended up becoming a marketing actuary at Taxevity and ended up where you are right now?
Yes, quite bizarre, because I didn't ever contemplate this. I wanted to help the public, but I didn't know how to get clients.
How to accomplish that.
But clients were coming to me, and in 2009 I started Taxevity so that I could help them by providing fee-only insurance reviews of their life and health protection.
Okay. Now, I am a fee-only financial planner. It's a very small industry. Not a lot of people know about it. I know about some of the fee-only financial planners out there. I've never met a fee-only actuary. So I have to say, despite the fact that we're in a similar industry, you're very unique. And is that fair to say? Are there many fee-only actuaries out there that are doing this type of work?
Well, there aren't a lot of actuaries to start with. I think
Right.
in Canada there are about 3,000, and virtually all of them work in the industry. I don't want to say there are no others doing what I'm doing, but if there are, it's probably less than 5 or 10 in the whole country.
Wow. So what do you do? A consumer comes to you, they're interested in getting some advice as it relates to their, well, maybe we start at the start. Why would somebody come to you? Why does somebody come to you in the first place?
Well, the main reason has to do with trust. The client isn't sure that they've been getting good advice from their advisor, or it could be that they had received a lot of service in the beginning, but the years have passed and they're not getting that attention. There's something bothering them, and they want to make sure that they are protected, because insurance ultimately is a promise, and they don't know if that promise is sound. So what they would do is they would somehow find me. That's the challenge, is just making people aware of me, which is why I'm glad to meet fee-only planners like yourself, Jason, because we're in a similar sphere. And then there'd be a 3-step process. They would come in the first meeting and describe what their issues are, and then we would figure out what their challenges really are. Because sometimes what someone thinks is the problem is not the actual problem.
And the issue may be, do I have the right amount of insurance? Do I have the right kind of insurance? Things like that?
Yes,
Okay.
it varies, but there's something that is bothering the client and they want someone to talk to. So what I do in the first meeting is help them understand what their real issue is, and then they'll leave their stacks of insurance policies and illustrations, other things that they have, and then I'll go into the actuarial cave and do all sorts of calculations to figure out what may be missing.
So you then do your homework, and meeting 2 comes about, and what can someone expect in a second meeting?
Okay, in the second meeting, we sit down and we look at recommendations that I've come up with to help them with the issues that they've identified.
And what type of recommendation would you make? Somebody has an existing insurance policy, there's something about it that you don't like or a hole that you see. What sort of action could they take?
Well, sometimes they don't need the insurance that they have, or they have the wrong type of insurance. That becomes tricky because it's not always ideal for clients to cancel coverage that they have because they're tax advantages. But we basically look and see what the challenge is, and then at some options.
And an option could be canceling and changing, it could be modifying or canceling. Are those the types of things that somebody might hear from you?
Yes, because sometimes they can just make changes to what they already have, and if that's possible, then that's the ideal.
Now, if you could enlighten our viewers as it relates to an insurance policy. I think a lot of people are used to getting a policy, paying the premiums, and then maybe canceling or stopping when a renewal notice comes up and the premiums are too high or they don't need it anymore, whatever the case may be. I don't know that people are that well versed in how you might change an insurance policy. What type of options are available as it relates to making changes?
There aren't a lot of options once a policy has been issued. There are a lot of choices prior to the policy being set up. So it's very important to be working with a really good advisor right at the outset, because once the policy is in place, then it's a contract. There are some options in it, but they're fairly limited. One of the things that a client could do would be to cancel the coverage. That's certainly an option. There may be some other options with some insurance policies. They can maybe put in more money if it's a permanent life insurance policy. They could maybe take money out of the policy or borrow against it, different things.
Okay. And so then after that second meeting, when you make your begin to make your recommendations as it relates to the policy and whether or not it's the right type, the right kind, what changes and options are available, I gather there would then be a third meeting or potentially a third meeting?
Well, generally the process is then finished because I've done what the client is looking for. So what they can then do is go back to their advisor to make the changes, or they could go and find another advisor if they wanted to make changes. And what I found is that when clients were coming to me, it was because they didn't trust their current advisor. And they were reluctant to go back to that same person to get the changes made. Because then there could be arguments, or it just wasn't something they wanted to do.
Sure.
And they weren't keen on finding another advisor, because how would they know if the new one is good? And so they would ask if they could get the insurance from me. And a couple of years ago, I got licensed. So if they want to conduct the transactions, because it's really just paperwork, filling out forms, then they can do that with me also. So it's up to them.
Okay.
And if they wanted to do the transaction, then there would be another meeting to complete that.
Fair enough. So you wear a couple of different hats. So there's a couple of different roles. You can be the doctor. You can do a checkup as it relates to somebody's insurance and see if their insurance policy is in good health, and if not, you can also write a prescription potentially if they're so inclined, but they don't need to fill a prescription with you necessarily.
Yeah, that's a nice analogy, because my mom wanted me to become a doctor, so I guess I can argue that I am in some form.
That's right.
Yeah, so that prescription can go wherever they want, but if you go to your doctor, often there's a pharmacy right there.
Right.
And if you want, you can just go to that pharmacy. What's interesting about insurance is that if you go to a regular medical pharmacy, there are different dispensing fees. With insurance in Ontario, the life and health insurance is always sold at list price, and there are no additional dispensing fees, so you don't save money by saying, instead of going to my doctor, I'll go to Walmart or Costco where the dispensing fees are lower, because there's no difference.
So then what I'm understanding then is it almost doesn't matter where you fill the prescription. It doesn't matter where you purchase an insurance policy as far as the actual product itself that you're getting. It's the upfront, it's the advice, it's understanding what you're getting, if it's what you need, and that's really where the focus needs to be when somebody is either purchasing a policy or reviewing an existing policy.
Yes, that's correct, because the same product would be available at the same price from anywhere. Okay. So if it's a policy, say from Manulife for the sake of argument, then Manulife would have the same price no matter where you buy.
Okay, fair enough. And now you mentioned the concept of trust, or the concern about trust that some people has as it relates to their insurance agent. Certainly, it's something I hear a lot about in the financial industry. Period. I find that the insurance industry, the financial industry in general, can be an area that people don't necessarily trust all that well. There's good stories, there's bad stories out there. What has your experience been working on both sides of the industry?
I would say that trust is the biggest issue that the public faces, and I have several slides that help show this. Edelman does an annual survey, they call it a trust barometer, and the financial sector ranks at the bottom year after year, so it's the least trusted in the world again. And so trust is definitely an issue, especially after the last meltdown. The Globe and Mail did some investigation into the insurance industry recently, and if you look at your screen, there are quotes there, but basically it's saying that commissions, bonuses, and pricey all-expense trips often factor into a broker's decision to recommend particular policies. That's not something that you'd want to see. And then they go on to say that such incentives amount to a conflict of interest that the industry is doing its best to keep to itself. So the question becomes, who is looking out for the client? And they did more investigation, and they saw that the regulation of advisors is a little limited. So they say that once licensed, this is from the Insurance Council of British Columbia, the executive director there. What he says is that once licensed, a life agent is not subject to any mandatory industry oversight, which differs significantly from all other sectors of financial services. So that's different than people selling investments or home insurance or car insurance, other types of things. And then that goes on to say that this is putting consumers at risk, but not much is being done about that problem. So when it comes to getting information and advice, this chart shows that accountants are the main source of advice that people go to, and financial people are at the bottom. Now, it's great to go to your accountant because they're generally on the client's side, but they rarely know how life insurance works. And that makes it difficult for them to give advice in that area. I mean, you're very experienced as a financial planner, but you may not be as aware of how life insurance works. And then another survey, this is a Gallup poll, looked at honesty and ethics, and it would be tough to get much lower than the ranking of insurance salespeople, unfortunately.
Wow.
So it's not a question of the glass being half empty or half full. The glass is broken. The trust is definitely a problem. And that's what people are trying to find because they're dealing with complicated products and they don't know where to go for help.
Well, certainly one of those places that they can go is to the insurance doctor. It's better described. Given the surveys there, it certainly speaks to you putting yourself out there more as a doctor than an insurance agent or a financial advisor. You can be an insurance doctor, I'll be a financial doctor, and those of us who, or those of you who want to stick around, we're going to talk a little bit more about trust within the financial industry, the concept of fiduciaries. We'll be back before long with Dr. Promod Sharma. Hi everybody, welcome back. I'm Jason Heath. This is the Objective Financial Hour. We're here today speaking with Promod Sharma, a marketing actuary with Taxevity. We've talked about a number of different things as it relates to insurance, the insurance industry. I wanted to speak a little bit about what's at the core of insurance. Insurance, as I understand it, for the most part, is a risk management tool. There are other ways in which insurance can be used that have estate or tax planning reasons attached to them. But I wanted to speak, I think, primarily about what insurance is. Insurance to me is something, and I think in particular life insurance seems to be the main insurance theme that I see out there, and it's kind of a crummy investment to a certain extent because you only win it as an individual if you die. It doesn't seem much like winning, but you know, people are certainly scared of dying, and I find that as a result, sometimes they don't like to talk about death, whether it's insurance, whether it's wills and estate planning. You want to talk a little bit about insurance and the risks that it's used to mitigate against?
Sure. Life insurance, as you're saying, is something that people are not that keen on getting, but it offers some very interesting advantages. And I don't know if you're old enough to remember Pink Floyd, Dark Side of the Moon?
I have heard of Pink Floyd.
They used to have these vinyl records. This is going back to the
Vinyl.
70s. Yes, the 73. I was just a kid myself. But one of their songs was Time, and in that they talk about you're older, shorter of breath, and one day closer to death.
Yeah.
And that's why I wanted to get into insurance. Well, not quite. But what they're referring to, in my interpretation, is the mortality curve, which you can see on your screen. What happens is that each year we get closer to our life expectancy, our expiry date. And so if we're buying insurance, which provides a lump sum if we pass away, then we'd have difficulty paying for the insurance year by year. Because when we're young, say in our 20s, the insurance would be very inexpensive. But as we get older, we would find that the insurance is virtually unaffordable. So if you had $1 million death benefit, you get to the point where for that year you need to pay $700,000 or some crazy amount because the chance of a payout is so great. The government realized that it's important for people to have insurance to protect themselves, because if they don't, then society ends up paying for them. So the government decided that they would use the tax system to provide incentives for people to use insurance. And so if you look at the most basic type of insurance, then what you have is a tax-free death benefit. So you pay with money that you have after you've paid taxes, and then you get the death benefit tax-free. That's term insurance. So that's much like your home in the sense that there's no tax on that. But you can't just pay the premiums year by year because they get unaffordable. The government realized that people needed to put in extra money now as a savings so that growth would then help cover the costs later. And so with life insurance, what happens is you get tax-sheltered growth. Now you have something which is like an RRSP, except it's better. With an RRSP, there's the same maximum limit for all Canadians. With life insurance, the amount of money that you can put into a policy is based on how much insurance you buy. So if you want to put in a larger amount, then you simply buy a larger policy. So you have this envelope for tax-sheltered growth. And the government thought, because insurance had these capabilities before RRSPs were even invented, which is a little over 50 years. The government thought that if you reached retirement age, you may not need the insurance anymore, but you can now draw down these savings as a form of retirement income. And so what they thought is that you would then take withdrawals from the policy and they would tax that as if you had earned interest. But that wasn't such a bad thing because now you had protection and you also have these savings. But the banks thought that there was something better that they could offer. They said that what you have is an insurance policy which is backed by a multi-billion-dollar insurance company. Why don't we lend you money against that policy using the savings as collateral? Loans are tax-free. And so this was a way that people could then get tax-free access to their savings without taking withdrawals. Now you have something which is like the tax-free savings account. Now inside insurance, the investment choices are fairly limited. And so if people are putting in extra money as a savings mechanism, they may not like the choices there, but what they can do is borrow against their policy to invest
in whatever they want.
Right, so then they're creating tax deductions by investing, and now they have something like a home equity line of credit. So a simple, boring insurance policy can lead to some pretty creative tax options.
Okay, and the tax deductions come from the interest on the borrowed money that is otherwise tax deductible as long as it's invested in stocks, bonds, mutual funds, real estate, businesses. So there's a lot of different. So in effect, it's a way to invest in things other than the investment choices that are offered by the insurance company.
Yes, because the investment choices inside insurance are fairly limited because the government never intended insurance to be a flexible investment vehicle. And so the choices are fairly small and the costs are relatively high. The government has a hidden tax called investment income tax, which they charge to insurance companies, and the insurance companies simply pass it on to clients. It's about 50 basis points these days.
And they pass it on through higher premiums or higher MER fees on the investment choices?
Yes, they would generally pass it on through higher investment loads.
Okay.
So if you look at investment choices inside Universal Life, for instance, they would generally be more expensive than outside because this additional tax has to be paid.
I see. Okay. And I can remember reading David Chilton's The Wealthy Barber, and there was always this concept of buy term and invest the rest. It's a question that comes up a lot, I find, when it comes to insurance and the insurance industry. Is there a one-size-fits-all answer?
Of course there is not. It's hard to have generalizations like that, but I think the basic problem with this buy term and invest the difference argument is it doesn't start with the client's actual need. Does the client have a temporary need or a permanent need? If the client has a temporary need, then term insurance is fine. That's all they need. Now, if they have a permanent need, then the question becomes, how do they pay for that insurance? Since insurance does provide an envelope for tax-sheltered growth, it does make sense to put money into that policy to get that growth. Now, what kind of money would you put in that? Perhaps money that would be going into GICs or fixed interest, because that's very heavily taxed outside. So you can look at an asset reallocation. But I look at it more as, I look at it as starting with the client's need, temporary or permanent, and that avoids the whole discussion of whether one is a better investment strategy than the other, because insurance is not intended as an investment. It's intended to provide a death benefit. There are investment components, but I find that sometimes advisors sell the sizzly, exciting things and overlook the basic things that insurance is designed to do.
And having been on the inside looking out in the industry, I gather you saw a lot of that. That it was, how do we position an insurance policy to the consumer of that policy to encourage them to buy the one we want them to buy? How can we make it more interesting? And I gather there's a little bit of that in the insurance industry, trying to direct, and likewise with the investment industry, trying to direct consumers to certain products.
Yes, the products among companies tend to be pretty similar, and insurance, I mean, you pay a premium. If someone dies, there's a death benefit. Like, it's very simple, but that's not very appealing. And so companies will come up with different strategies, wrappers, whatever you want to call them. So when I was designing products, I would keep getting requests for, can you develop a wrapper that does this or a wrapper that does that? An example would be, and some of these wrappers have emotional appeal, but they're solving a problem that may not even exist. A relatively common wrapper would be something to preserve an RRSP. As you know, when a client dies, and they don't have a surviving spouse, then there's tax on the RRSP. So if someone has, say, $500,000 in an RRSP, then about $250,000 gets paid in tax. And Canadians find it emotionally tough to pay tax. And this seems like a crazy amount of money to pay. They forget that they had tax deductions when they put the money in. If they took the money out the day, well, okay, the way the insurance comes in is an advisor will say, okay, you have this tax to pay, why don't you buy $250,000 of life insurance? And that will be a much cheaper way to pay that tax. But what gets missed on this is that if the client took the money out the day before, they would have paid the tax. So to have insurance pay the tax is really to use insurance to increase the size of the estate by focusing on an emotional angle, the client not wanting to pay tax.
Right.
So that's solving a problem that doesn't really exist. And there are other packages that look appealing, but if you really look at what they're doing, then maybe they're more to sell than to solve real problems.
Yeah, I suppose in a case like that where either an insurance agent is trying to sell a policy to pay the tax on RSP, or somebody has purchased it solely for that purpose, as an actuary you'd be able to crunch the numbers and see what would happen if you otherwise took those premiums and invested them, and I bet you in a lot of cases, you'd end up with that same $250,000 in another way, shape, or form. You'd build it up in an investment account instead of paying the premiums. I've always thought it was strange to buy an insurance policy to pay the tax on our RRSP, but it's certainly a selling feature that I have come across many times when asking people why they have a certain insurance policy, and obviously that's what they've been sold or told by their insurance agent. Now, there are situations where having insurance to pay a tax liability does make sense, I gather. I would say probably more often than not when there's a business that could have a big tax liability on the owner's death, or a piece of real estate or something like that. So again, I guess it's sort of hit and miss as to whether or not you buy an insurance policy for a tax liability.
Well, that's more of an accounting question, but accountants seem to feel that insurance is a good solution in those types of situations, that upon death there is a large tax liability. If there's a couple, then assets can be transferred to the surviving spouse, but when that spouse dies, there's tax to be paid. And then it becomes an analytical question of how to pay that tax. There would be assets available at that time, but maybe, say the assets are, say even stocks, the market may be bad. you can't tell CRA that, okay, we will pay these taxes, we promise.
We don't want to sell the stocks right now.
But we don't want to sell these right now, or we don't want to sell the cottage. CRA wants their money. And where do you get liquidity? Insurance is a very effective way to do that. And the cost of insurance is relatively low compared to the tax. So it can make excellent economic sense. Some people with a charitable goal towards the end of life also buy insurance. So what they can do is have a gift given to a charity which they've purchased through an insurance policy. So there are different things that can be done. So applications like that are solid business uses of insurance. And also there may be a desire to leave money to heirs, etc. And insurance is a good way to do that. Someone may have a business, for instance, which is going to go to one child, but then the other, and there's another child, what do you give the other child? Well, maybe you decide that they each get the same amount and you buy insurance so that cash can go to that person.
Okay, so it sounds to me like most people should be looking at life insurance as a risk management tool to protect those that could be left behind when they die. Taxes can be a reason to buy insurance policy, but not always. Beware the pay the tax on your RSP ploy. And beyond that, charitable endeavors, insurance policies can be an interesting way to do that. And beyond that, I know there are some other reasons that insurance can be used, should be considered, and we're going to talk a little bit more about those after the break. Hi everybody, I'm Jason Heath. This is the Objective Financial Hour. We're here today with Promod Sharma, a marketing actuary at Taxevity. We've been talking a lot about life insurance, and one of the things that we haven't really spoken too much about is ways in which a life insurance policy can be used as an investment. Certainly people who have money that they're likely to pass along to the next generation in some way, shape, or form. There's lots of different ways in which they can do it. They can pass it along before they die. They can pass it along after they die. And if they're passing it along after they die, it's a matter of how is the money invested in the interim. There's stocks, there's bonds, there's mutual funds, there's real estate, and there's insurance. And I gather insurance can be an effective way to create an estate and pass money along to the next generation?
Definitely, because it guarantees a certain amount of money at just the right time. Someone may be investing to accumulate, say, $1 million at a certain point, but if the person passes away prior to that, they may not achieve that, or the investment returns may be quite volatile and they may not achieve that. With insurance, you can structure it so it will do what you intend by just paying particular premiums.
And so from an actuarial or statistical perspective, is there a certain type of person who knows they're going to be leaving a legacy who should consider life insurance? Should it only be people that are healthy? Should it only be people that are feeling kind of sick but nothing's been diagnosed so they can fly under the radar and and not get rated highly. What type of person is going to benefit from using life insurance as an estate strategy?
Well, many people can benefit. You use the example of someone who may not be very healthy. If that person is married, then they could purchase a joint last to die policy, which means that the death benefit gets paid when the second person passes away, which is when the tax liability would occur. In that situation, you could have a life that is virtually uninsurable and also put them on that policy.
Okay.
Because what happens is, from the way the rates would be calculated, you're essentially buying a single life policy on the healthy life. Mm-hmm. You're basically ignoring the unhealthy one. And so you can do something quite creative that way. If it turns out that both people are healthy, then rather than buying separate policies on each, you could buy a joint last to die policy, which would pay when the second person passes away, and that would be much cheaper than buying the two separate policies. So there are creative things that can be done, but it's really difficult to give one-size-fits-all advice to the questions that you're asking.
Okay. So beyond life insurance, which we've talked a lot about, and I find that tends to be the type of insurance that most people have, most people are aware of. There's a number of other types of insurance out there that I was hoping that we could focus in on a little bit. One that I certainly find is ignored, that is a big risk, is disability, is the risk of becoming disabled, and the corresponding tool that can be used, disability insurance. Can you talk a little bit about disability insurance?
Yes, I find that life insurance, for many people, term insurance is adequate because they need to create an estate, they've got families, etc. And it's very inexpensive because not many people pass away. So it's almost like buying a lottery ticket for the immediate needs. So that's pretty inexpensive. But if you look at health, there are good chances that something will happen to us during our working lives. There'll be scary statistics, say 1 in 3, 1 in 4, etc. May have a disability or a critical illness. And so it's very helpful to have protection in place for those things. The difficulty is that people think nothing will happen to them. And as a result, why would they want to waste money buying insurance when they feel that they'll be one of the lucky ones? With some of these products, you can structure them so that there's a return of premium option. And what that means is that if nothing happens, then when you retire, you can get your money back. If you look at it that way, you have an alternative to other forms of saving for retirement. Because if someone is trying to save money and they got disabled, then where would they have money to save for retirement? So if they took money that would otherwise go to retirement savings and bought disability insurance, they have a greater likelihood of saving money, or having income for their retirement. And then if they reach retirement and nothing has happened, then they can get money out of their policy to use towards their retirement. Critical illness can also be structured the same way. So I believe that it's more important for people to get health insurance, like critical illness insurance and disability insurance, than it is to get life insurance. I'm not saying don't get life insurance, but people tend to get that anyway. But they tend to ignore the costs of health, and that could be quite devastating.
I tend to agree. I find it's more overlooked, and I think that even beyond that, there's a lot of people that have an existing disability policy, or they've got a group disability policy that they assume is sufficient. And one of the things that I've been continually advised against assuming is that you've got the right definitions in your disability policy. So I gather it takes a trained eye to look through a disability policy and explain what you've actually purchased?
Yes, because if someone has coverage from work, then that's an employee benefit. That is a cost to the employer. And employers nowadays like to minimize the cost. So they'll provide some basic protection, but they may not provide or are unlikely to provide very comprehensive protection. They may have different levels of protection, so the senior executives may get nice protection that the other employees are not getting. It's very difficult for someone to just tell from their statement of their group insurance what they do have. So it can be beneficial to have separate insurance that's designed for them. The ideal definition of disability would be saying that you're not able to do the work that you currently do and then get paid. Some policies say that if you are able to do any other kind of work, you do not get paid. So for instance, in the kind of work that we're doing, actually, I can't think of a good example right now, but
okay.
there could be situations where it just...
Sure.
Yeah.
I gather disability insurance, if the definitions are not right, the policy may not pay out, even though you may not be in a position to work in the way you might have become accustomed to working. So now disability insurance is an insurance that protects you against something happening where you can't work, you can't earn income replacement to a certain extent. Critical illness is as well, I guess, a newer type of insurance that I find not many people are aware of and not many people have. What exactly is critical illness insurance and who should be considering it?
Okay, critical illness insurance provides a lump sum if a patient or a client is diagnosed with something serious like cancer or they have a stroke, etc. The payment takes place about a month after the disease has occurred, and the lump sum can be used any way that the person wants. So you could have a situation where someone needs treatment, and in Canada maybe they'll have to wait months and months to get that treatment, but with money they could go down to the US and get the treatment tomorrow. That could be a use of the money. Someone may end up being in a wheelchair, and then they need renovations to their house to accommodate a wheelchair ramp. They need a different vehicle that can accommodate a wheelchair. Well, where is the money going to come from? The money could come from a critical illness policy. Or there could be really dire situations where there's nothing that can be done for that person, but maybe the money gets used to bring the family together one final time or one final trip. It really depends on what the person wants to do. And these policies are also available with a return of premium option, so that if there is no claim, then there's an opportunity to get money back later and use that towards retirement savings. So I think critical illness is an important type of protection for virtually everyone to buy. Life insurance is less essential for people who are on their own, who do not have beneficiaries. Critical illness insurance and disability insurance help the actual person who is buying the coverage.
So almost everybody should have disability insurance, or at least consider disability insurance and consider critical illness insurance. Life insurance for somebody with no beneficiaries may not be a good fit. Something that I think is very top of mind to a lot of people these days with the aging population here in Canada and the baby boomer generation is long-term care insurance. And likewise, I find it's an insurance type of policy that I don't see very much out there. Can you speak a little bit to long-term care costs and how you mitigate that risk?
Yes, with long-term care, what happens is that we reach an older age and we're unable to carry out certain activities of daily living. Generally, there'll be 2 out of 6 that cannot be done. So for instance, if we're not able to eat on our own or bathe, those are things that would qualify as things that, well, depending on the definition of the contract, those are things that may qualify the person to get money. And what happens is with these policies, it'll pay a certain dollar amount. The benefit might be $100, $200, whatever it happens to be.
Per month.
Per month, that could be used. And so you'd probably want more than that because that wouldn't cover very much except coffee in the future. But you can buy that type of policy to help cover the costs. A place that it can be appealing is for people who have elderly parents, because at some point they may require assistance, and not everyone is able to take time off work and look after an elderly parent.
And so this is something that a child can buy for their parents, or not so much a child, an adult who has elderly parents can buy a policy on their parents?
Yes, or the parents could buy it on themselves also, because if the insurance is not in place, then a good portion of the estate could get chewed up in covering these medical expenses, which leaves less for the heirs. a cheaper way to provide for that money could be through long-term care insurance.
And when should somebody be looking at a long-term care policy? Is this something that you're better off looking at when you're young and starting early and, you know, putting money aside when you're 25 years old, or does it tend to be something that's considered closer to retirement?
Well, with insurance, it's always better to get it earlier because it's always cheaper at that stage. But when people are younger, they have other issues to deal with. So a really good time to think of getting long-term care insurance would be when someone is in their 40s or 50s. But at that time, they may still have children that are in university or be paying off a mortgage. So in reality, people tend to think of this kind of insurance when it gets closer to retirement, say in their 60s or so. And at that point, it becomes more expensive. One of the big challenges with long-term care insurance is that we have a misguided view of how good our healthcare system is. We have a tendency to think that if something happens to us, there will be some government program that will take care of us. And that may not be the case. And so why would people buy insurance for something that they think they're already covered for? It becomes an education process, and who wants to hear about really horrible things happening when you're old and you need medical treatment? So it makes it tough for advisors to talk to clients about these types of policies because not many clients would be interested.
Now, one more thing that I wanted to speak to is I find there's a common misconception within the broader financial industry that people in the industry are fiduciaries and have a fiduciary responsibility to do what's right by their client, whether it's investments, insurance, otherwise. I think a lot of people out there think that an insurance agent is a fiduciary and is representing their best interest at all times. Is that a complete misconception?
Unfortunately, it is a misconception. When I got into insurance...
Complete's a strong word, but it is a misconception.
It is a misconception, yes, for the benefit of any lawyers watching. When I got into insurance, I thought that people selling the products were fiduciaries. They were doing the best for their clients. When I got involved more deeply, I saw that, in fact, the advisors are really salespeople. And it's not that they're out to do bad things, but the fine print in all proposals will say that before you decide to buy, go and talk to someone you trust who can help you understand this. The client thinks they're already talking to that person. They don't know where they can go for advice. They could go to their accountant, but accountants are not aware of how insurance works these days. Some of the options are very sophisticated and the results depend a lot on assumptions that may or may not be accurate. And so it's tough to find, it would be risky for someone to call themselves a fiduciary even if they're acting like one because it brings on legal responsibilities. But the reality is that clients are dealing with commissioned salespeople, and while they may not be out to do bad things, they do have different interests. And if someone on commission recommends an option with higher compensation, they get more, but the client is probably getting less.
I can certainly say that my experience within the financial industry has been that most people out there are good people that are trying to do the right thing. Like any industry, financial industry or otherwise, there's always going to be good apples and bad apples. Sometimes it's simply a case of not knowing all of the ins and outs of a particular investment or insurance product. Sometimes it's just not understanding all the different options available. One thing that I can certainly say is that the type of service you're providing is very much needed within the financial and within the insurance industry. It's educational, if nothing else. Financial literacy is becoming top of mind now for government, and it should be top of mind for individuals as well. And for those people that are looking for a little bit of literacy as it relates to their insurance policies, whether it's a policy they already have or a policy they're considering buying, they should get in touch with Promod Sharma, and he can help you assess it, and he can do something that not many people out there in the industry do. Promod, thank you very much for joining us today. Everybody, Promod Sharma, Marketing Actuary at Taxevity. I'm Jason Heath of the Objective Financial Hour. Good night.